So, I mean, the main backdrop, main thing that is QE, it's pushing markets higher. It continues to go at the 120 billion a month monthly pace, but we're seeing this huge drop off in economic surprises to the upside that are now leading to the downside. So the Fed and global QE continue, which is helping markets, and 80 billion of that 120 billion is in treasuries. But now there's kind of a big question mark for markets surrounding tapering, when it will start, and what type of a pace of tapering. And then the other big question is, how much of the slowdown do we get for how long due to the Delta variant? And so there's kind of a little bit of a ceiling on the market from that degree of uncertainty, and there's risk, and we still have a backdrop internally, which is a two-way, more questionable environment. So you want to still lean long, but you want to have your trigger on the finger if we need to hedge and we get further correction signals. And you probably want to be lighter than normal because the risk is still higher than everything. The other thing to think about is that if you have, first of all, we really want to watch commodities now, because generally, if we get a situation where there's tightening that's more than the market believes is healthy, maybe a bigger pace of QE tapering than the market would like, and that combines with a kind of a slowdown that the Fed really hasn't fully acknowledged yet, that's when commodities are vulnerable. You can get a big decline in commodities, and if commodities start dropping sharply, that can easily spill over to a correction in the market. So we kind of want to watch commodities closely as kind of a canary in the coal mine for whether the Delta variant slowdown is getting to the point where it's really starting to change the narrative. And that's when we can get a hit. And of course, if we get a hit, we get supply coming on, our supply and demand balance is still not really strong towards demand, which means that an onset of supply could have a bigger than normal hit to prices. Now, we have had sort of the first confirmation of, had a lot of higher frequency data, which we'll take a look at, showing the slowdown. But this was the big one was on Friday. We had the downshift in non-farm payrolls. 235,000 came out versus 1 million last month, and 733 to 750 that was expected. So that's a very weak number that is probably going to sway the Fed to either cut the pace of tapering or maybe not start it as soon. But that's all conjecture. That's kind of what the market's thinking. So a slowing rate of growth would diminish the sense of urgency for the central bank. There's also been expressed concern from Powell that as we move into the winter months, the rate of infections could increase further, because winter's when it really takes off. We've had that situation that Chuck talked about that really hit it on the target, which is in the South, in the areas where it's really hot and humid. There's actually a boost in COVID cases there spiking, because that's when everybody's in the same room, an air-conditioned room together. But in a lot of the rest of the country, that happens in winter. And that's when we get the spike in cases. So we've got that seasonal problem they're going to be worried about. Powell has said that his study of history is that when you remove stimulus too quickly coming out into a recovery, that actually causes more harm than good. And so I think the doves are in a pretty decent place. They'll err on the side of caution. So right now, the September 22 FOMC meeting is expected to be the announced date, when they announce when they'll taper, and they'll either talk directly about the pace of, which is assumed to be something in the range of 15 billion to 25 billion a month of taper. Now we could get, and it's expected to be early December. It's possible that they definitely won't start till early December or maybe later, and they might start the taper even smaller, which would be positive. Those would help the market as long as we don't get a big enough slowdown that hits the market on its own. And so far, this level, we're still in that kind of Goldilocks zone. Now, most of the payroll disappointment came from leisure, hospitality, sort of reopening theme industries, just kind of a big clue that it is directly related to the Delta variant, and that's bringing the growth rate off the board. The ECB has a meeting this week. It's likely to talk some about tapering, but it's probably going to be following the Fed. It may have a brief impact, but it's not nearly going to be what the market is focusing on as much as the US. And then Japan has their own situation where essentially they've had a resignation. They're going to have a new prime minister, new government there, and that basically those guys are going to be implementing more stimulus than they were before, and that's taken as a market positive. So remember, the focus now that we're in a recovery, particularly the focus now is on stimulus. What's going to happen to stimulus? And that's really what markets are really watching closely. We showed this in PSL, but it's worth showing again. This is basically demand in red, supply in blue, and spread in gray. And what I want you to see is, even though we've had some improvement, we still have a huge list of stocks meeting our criteria on both the long and the short side, as we'll see. So it's a two-way backdrop. It's still decent for the real leaders that are clearly leading on the upside. But for the broad market, it's much less of a improving participation backdrop that you want to see for something that's really going to be sustainable going forward. We would like to see supply break below this uptrend line and demand break above this downtrend line to really, and maybe spread break above its downtrend line to really give an indication that, okay, we're in this two-way backdrop. We've had some kind of warnings that are telling you there's problems with participation, problems with narrowing internally, but we're starting to see enough things happen that's likely to give way to a sustained advance before we get some problems. So right now we're still kind of questionable. That means don't take as much risk, realize that risk's high, and kind of have your finger ready on triggers for hedges and things like that. If we get another signal that tells us, all right, supply is coming on really strongly and we're in a vulnerable supply demand balance where it could hit prices harder than usual. Now, the other things to kind of watch, these are the laggards, I would say. And so small caps are really the biggie. You can see here's the relative strength of the trend versus the S&P, and it's in a downtrend. We'd like that downtrend to break. And we would like for IWM to break out of this 234 high here to show you that range is really breaking. We're starting to see improved relative strength. What that means, the small caps and the mid caps have been the area where the participation has been weak. And so if those start to come on, we get good breakouts on good volume. We get good breaks on the relative strength to the upside. Those are the types of things we really want to see to say, okay, participation is starting to increase and there's potential for another leg here before we run into big trouble. Transports are another really lagging area, so keep your eye on those. And you can see we've kind of got a trading range base potentially, which could go either way. And you can see the same thing on the relative strength. It's kind of a double bottom here. We want to see breakouts in both of those to say, okay, the cyclicals, the reopening themes, the things that are dependent on the variant, Delta variant not getting worse, those are starting to participate. And small caps are too. All those things would tell you, all right, we're getting a level of participation now that will allow us to participate more heavily and more aggressively in a rally mode. So, and we've got the levels to watch there. You know, to realize that we're in this period where the seasonality is sort of negative. That seasonality doesn't mean a lot when you've got overwhelming forces like QE, but just note that from 1928 to 2000. The biggest down month is September. And from 1950 to the present, what I want you to see is, okay, most of that is in the back end of September. So we get to this sort of latter half of September through October to the end of October. It's really kind of one of the most negative seasonals of all periods in the market. Doesn't mean that the market can't rally if there are overwhelming factors, but the tendency is for there to be some kind of a correction. And as we'll look, you can see that here from 85 to 19, you can kind of see this is the typical and you see that all these, whether it's NDX, the Russell, or the S&P, they all tend to have some sort of a correction into sort of this late October to November period. And then the strongest period of seasonality typically develops. And this is a Larry Williams thing. It's just showing you, here's the dead stupidest strategy you can think of, which is basically we are looking at this number of trading days into October, and we're just buying with a $2,500 open protective stop S&P futures. And here's kind of how it's done. And what I want you to see here, the real key is after the 19th trading day, you really get high reliability of the market moving higher. And that's the 27th of October this year, the 19th trading day. So you can get bottoms anytime in October, and that's the month where you have more corrective bottoms than any other month of the year by a mile. But really you get towards that very end of October and you start getting a very strong seasonal up. So let's just be watching for that. If we happen to get a big correction or that yields the kind of correction over signal that we really like to get, that would be fantastic. That would open up a new opportunity, but could be some damage. So you just kind of want to be aware of that. And then also, as we've talked about before, that, when you have these years that are up strongly through August, yes, you have often corrections, major corrections, but in general, you're higher more than average percentage of the time and a higher amount than usual. However, there were some big major outliers. This data does not include 1929, and the September-October period of 1929 would make this negative. So depends how far you go back. And 1987 also occurred in that period. So, I just want people to kind of realize the seasonal period that we're in. There's been some evidence that the rally has been broadening, which is good. It's not enough to really turn our internals completely thumbs up. So we're still kind of a yellow caution light two-way backdrop that's getting a little more skewed toward green. We still like financials as kind of a hedge because here we are continuing to get these upward pressures on rates. And that's likely when tapering starts to continue, et cetera. And so we break out here. You could play TBT. We've started to nibble on that, but we kind of like financials because they can benefit from an environment that some of these other themes might get hit in for a little while. So continue to like the financial area as one of the plays that you're dealing with. Continue to really watch this. We're kind of stair-stepping higher. We get through this downtrend line. That's more evidence that rates are likely headed up. That's your TBT play.